What's up everybody? Nate here. Federal Reserve just had their first meeting of 2022, and Jerome Powell said that there is still a risk that inflation could go higher in 2022. And right after he said that, stocks essentially crashed. In this meeting, Jerome Powell and the Federal Reserve talked all about how they're going to tackle inflation in 2022. They also discussed the health and the future of our economy, when they are going to start raising their interest rates in 2022, by how much, how dramatic their stock market tapering is going to be, and their overall goals for 2022 and beyond. So today I want to break down this report and talk all about what has changed in this new Federal Reserve statement and what we can expect for the rest of 2022. We're going to be looking at the exact Federal Reserve transcripts that they just released on January 26th. So if you want to learn everything you need to know about this recent Fed meeting and what they plan on doing for the rest of the year, stick around to the very end of this video because we're going to break it all down. But before I break it down, do me a quick favor and smash, destroy, or hit that thumbs up button below. I appreciate you doing that because it helps me to know that you like this video and that you want to see even more. Okay, so let's talk all about what the Federal Reserve went over in this most recent meeting. Now, I'm going to read exactly what the Federal Reserve wrote in their most recent transcript. Basically, the Federal Reserve has prefaced their entire decision-making on rates and tapering on how our economy is being affected by the pandemic. They actually started their meeting by saying, while the economy has improved, the pandemic is still having a massive effect on jobs and our financial markets. They mentioned that job gains have been solid in the recent months and the unemployment rate has declined substantially. But they also continued the rhetoric that supply chain issues are causing the 40-year historic levels of inflation that we're seeing right now. And depending on which direction the pandemic takes, that will also shift the course for the Federal Reserve and will influence them on how they're going to make more actions in the future. So breaking that down for a minute, what does that actually all mean? Well, the Federal Reserve is in charge of a lot of the monetary policies in the United States. It's their job to monitor inflation and make sure that it stays at a healthy level. The Federal Reserve basically tells the Treasury Department how much money it can print every single year, which means they directly contribute to inflation, because the definition of inflation is when your monetary supply starts going up. That's why I say healthy inflation, because the Federal Reserve considers some inflation to be good for our country, around the 1% to 3% mark. That shows that there's a need for money and that your economy needs to start growing even more. More people need a lot more money. If the Federal Reserve doesn't print any money at all, well then that cuts off access to money for a lot of people. Because our population and our country continues to grow, people eventually are going to need more. However, if the opposite is true and the Federal Reserve prints way too much money, well then you have a spending problem in the United States. And that's kind of where we're at right now. The Federal Reserve has printed, around $5 to $7 trillion over the last 2 years, and that has contributed to society buying pretty much whatever they want. And when society goes out and buys whatever they want, well, that creates a problem with our supply chains. We don't have a lot because businesses are going to be delayed in what they can actually produce. So shelves are going to continue to be empty. And even when businesses start to produce more, all of that is going to come at a cost, which is why we have a marker called inflation. And inflation hit a new 40-year high in December 2021 of around 7%. So if the Federal Reserve is in charge of our monetary policy and monitoring inflation, and inflation is way too high in the United States right now, then surely it's the Federal Reserve's job to start dropping inflation. And that is exactly what they talked about in this meeting. After the Federal Reserve got the pandemic out of the way, they started to talk about what they're going to do in 2022. And one of those things is starting to raise their benchmark interest rates. So when the pandemic first started, the Federal Reserve dropped its benchmark interest rates to around 0%. The reason they did this is because they wanted to incentivize people to go out and spend money. Think of it this way. If you want to get a loan, but the interest rate is keeping you from getting that loan, then you can't afford it. However, if the interest rate is knocked down a couple percentage points, well, then all of a sudden you can afford to get that loan. That equaled a lot more money printing and it kept our economy going. Now, though, they're reverting that policy. they want to start raising rates, and they want to start raising rates as soon as March 2022. Now, the Federal Reserve hasn't exactly said how much they're going to raise rates, at least not at this time. However, it's anticipated that they're going to get extremely aggressive when it comes to inflation. And the reason for that is because inflation is at its highest point in a very long time. That's causing a lot of strain for Americans in just about every financial market imaginable. And ultimately, that can be deadly for an economy, but we'll get into that in just a second. So right now, it looks like they're going to raise rates about 3 times in 2022. All of those raises are going to be 25 basis point moves. But a recent CNBC poll showed that most traders and investors believe that we're going to have that interest rate bumped up from 0% at the start of 2022 to 1% at the end of this year. That means in order for the Federal Reserve to really address inflation and start tackling it, they're going to have to raise rates at least 4 times this year, and that is the general consensus right now. Now, what else did the Federal Reserve say in its most recent meeting? Well, it talked a lot about tapering its bond buying and asset purchasing on Wall Street. So to set the stage there, the Federal Reserve started buying bonds and treasury notes in the stock market as early as April 2020. And the reason for that is because they wanted to push the stock market up when it was essentially failing. I mean, in March 2020, we saw one of the fastest stock market crashes in its history. So the Federal Reserve decided to step in and offer liquidity to businesses and companies who really needed it. And they did that for a very long time. So much so that their balance sheet is now around $9 trillion, which means they bought around $9 trillion worth of bonds and notes on Wall Street. But by the end of the year 2021, money printer Powell and the Federal Reserve got together and said, hey, this inflation thing is not good, right? That's also when they decided to retire the term transitory, because they just assumed throughout the entirety of the pandemic that they were not causing any of the inflation. It wasn't their fault that prices were going up. It was the pandemic, and it was supply chain issues. So they coined the term transitory, so that way everyone in the United States felt like it's only temporary. All of this inflation is going to go away when the pandemic disappears. Well, we're nearly 2 years into this pandemic now, and inflation is not going away. So they got a little more serious and said, hey everybody, this inflation thing, first of all, not our fault, but second of all, it's way higher than even we thought it would be. So they started tapering their assets on Wall Street, which just basically means pulling back. They're not going to purchase as much as they were. Don't get me wrong, they're still purchasing billions of dollars in assets on Wall Street, but it's just going to be less and less every month, and it's really starting to ramp up now, or should I say ramp down. Reading directly from the transcript here, beginning in February 2022, the committee will increase its holdings of Treasury securities by at least $20 billion per month and agency mortgage-backed securities by at least $10 billion per month. Their goal is to be completely done buying all of these assets by March 2022. And their thought process behind that is that they want to make this process super smooth for investors and companies on Wall Street as we transition from a pandemic society to a post-pandemic society. And lastly, the Federal Reserve and Jerome Powell talked about inflation. So they specifically mentioned inflation and what they actually want inflation to be in 2022. From the start to the end of 2021, inflation went up by 7%. That means if something today costs $1, 1 year from now, it'll cost $1.07. And that's not really a big deal if you're only spending $1, but when you're spending hundreds of thousands of dollars, that 7% difference can be huge. Now, like I said, in order to drop inflation, they're going to raise their interest rates. They don't exactly know by how much yet, but they said definitively, we are going to raise our interest rates sometime very soon. This will hopefully bring them to their target inflation level, which is around 2.6%. So a little elevated, but not nearly as high as 7%. So basically, the Federal Reserve believes that ending their tapering and raising their interest rates will mean that inflation is going to get cut in half by the end of this year. So let's talk about what that actually means. So like I said before, inflation means that your monetary supply is going up. Technically, that's all inflation means. However, there are symptoms to inflation, like supply chain issues and the price of everything increasing at a rapid rate. The reason for that is because as the Federal Reserve prints money, that money is eventually trickled down to the American people. The American people have this money and they go out and spend this money. Now, during the pandemic and when the Federal Reserve prints this much money, for the most part, Americans need this cash. They have things that they absolutely need to spend on, and necessities can't be avoided any longer. However, that doesn't really solve the problem of inflation, because now as people have more money, they go out and spend this money and buy more things. Companies, though, don't really know that they need to produce more until they start running out. Once they start running out of things, then that signals to them that they need to start making more things. When they start making more things, they have to do more as far as the organization of the company. So they have to hire more workers and open more factories so supply can be increased, and then they can deliver those things to you. So they need even more delivery drivers. But that all comes at a cost to the company. So the way that they recoup some of those costs is by charging you more for each individual item. Now you're paying more, which means that even though the goods and services that you were buying before didn't really change, they're now more expensive. You need more money, which means the value of your money goes down because its buying power is decreasing as well. So basically, when you say you have an inflation rate of 7%, that means there is a ton of money that's being circulated and passing through hands in the United States. What's going to happen if you're targeting an inflation rate that is half that, so around the 3% mark? People are naturally spending a lot less money. And that's a good thing for inflation, because that means with less demand, there's a less need for money printing in general. It also may help supply chains to actually start producing more in order to meet the demand of society. It actually might mean that some companies overproduce because they're still expecting demand to be through the roof. But it may also mean that companies start making a lot less money, which could potentially be bad for the stock market after a couple years of massive gains. I mean, there was so much wealth in the United States in 2021 because there was so much money being circulated throughout our economy. Now, it looks like the Federal Reserve is basically taking all of that money away, and companies are going to suffer from that. Which brings us to the final topic of this Federal Reserve meeting, jobs. So that is basically one of the biggest goals for the Federal Reserve in 2022. They want to reach a point called maximum employment. Maximum employment basically just means that any American that is eligible to work and can work is working in the United States. However, Federal Reserve Chairman Jerome Powell pointed out the fact that job openings currently outnumber unemployed Americans, which is one of the reasons why the job market is very, very strong right now. Basically, what that means is there's so many jobs, and there is enough jobs for every single American that wants one. And right now, the unemployment rate in the United States is just below 4%. The issue is labor force participation is a lot lower than that. Because right now you have millions of Americans who are unemployed. However, they're not getting a job. There's a lot of jobs out there, but Americans don't want all of those jobs. That has also contributed to inflation because now businesses want to produce more, but they just can't because there's enough people in their company to produce those goods. Jerome Powell, though, does not believe this is going to be a problem, as he thinks raising rates will not be a significant threat to the job market right now. The issue is, while the unemployment rate is super low in the United States, if you start to raise rates, then that means there's going to be less money in the economy overall. And if there's less money going around, then that means Americans are naturally going to spend less. If businesses don't start making more, then how are they going to pay all of the employees that they hired in order to end our supply chain issues? Well, the fact of the matter is they're not going to be able to. So you might start to see millions of Americans lose their jobs because Americans don't need all of that supply anymore, which is exactly what investors are worried about right now. And it's part of the reason why we've seen the stock market essentially tank all throughout January. High inflation, Americans spending less, and the Federal Reserve tightening policy even more. Those three things are basically the perfect storm to create a recession this year. At the end of the day, you have to remember that markets are emotional. So they're going to go up and down and have roller coaster rides depending on what goes on throughout the rest of the world. For the most part, these aren't computers making a lot of these trades, they're people. And when the masses start doing anything, things tend to go in one direction or another. For pretty much the entirety of 2021, things went up. However, now starting in 2022, things are starting to go down. At the end of the day, the Federal Reserve's job is to lower inflation. So basically, Jerome Powell has a financial tightrope that he needs to walk here. The Federal Reserve needs to lower inflation, but they need to do it in a way that is not going to cause a recession or a stock market crash. But it's pretty clear here that they can't do both. They can't keep the investors on Wall Street happy while also allowing inflation to run rampant throughout the United States. That's going to hurt the everyday average American the most. So they have to be 100% dedicated to ending inflation. And basically right now, they're willing to use all of the tools that they have available in order to do that. So what exactly is coming next in 2022? Well, it's really anyone's guess. Nobody really knows exactly what's going to happen in any market. The stock market is no exception. It's anyone's guess because the economy and the world, for that matter, could do anything. We don't know what the pandemic is going to do. We don't know how people are going to spend their money overall. There is a ton of different moving parts here. So a lot of things could happen. Ultimately, I think it'll be a combination of a lot of the things the Federal Reserve is going to do and a lot of things experts think is going to happen. Jerome Powell said it himself, our economy is not functioning as it should right now. So even if we do see near recession levels, you gotta remember a recession technically is only 2 quarters of shrinkage in the United States. Our economy has exploded over the last few quarters, but that's only because it dropped so low before. So even if we see some slight shrinking, it might only be shrinking back to normal levels. What you can expect is the Federal Reserve to raise interest rates in 2022 and completely exit the market. That means the stock market will be basically back on its own and interest rates are going to start going back up to levels where we saw in 2018 and 2019. All of that means that our economy can start getting healthy again, start getting back to where it was before the pandemic started. And obviously inflation is not transitory. I mean, we've been saying that for a very long time. Inflation is going to be around for a long time. Now, I don't know if it's going to be around at the 7% mark, but these changes for the Federal Reserve are going to take time, which means it's going to take time for inflation to go down too. So we might see elevated levels of inflation throughout 2022 and into 2023, possibly 2024. But in the short term, nothing has really changed yet. A lot of the changes that are going to happen in 2022 are going to start in March. No more bond buying and asset purchasing and raising rates. So it'll be interesting to kind of see how the markets and the US economy start growing, progressing, or falling back at that point. But now I want to know exactly what you think about this issue. What do you think about the Federal Reserve's most recent meeting on inflation and our economy, jobs, and stock market tapering? Do you think that because of these monetary policies, our economy is going to grow and expand and get back to healthy level in 2022? Or do you think all of these policies are going to cause a recession? Whatever your thoughts are, leave a comment below before you go. But that is it for me. Don't forget to hit that subscribe button below if you like this video. Be kind out there, and I'll see you all in the next one.